Now, earlier this year, I jumped into ULTY, the YieldMax Ultra Option Income Strategy ETF. And if you've watched my videos, you know I like income-focused ETFs, especially ones that generate big, frequent payouts. Now, ULTY isn't just a plain vanilla dividend ETF like SCHD. We know over the past few years now, SCHD has been pretty subpar, which has actually been underperforming money market funds or even SGOV treasury bills. Now, prior to that, it has been having some steady growth in share price in addition to its dividend yield, but we can see since mid 2021 to now, which is a little over 4 years, it really has been pretty flat. So you're basically just holding this ETF and receiving a little under a 4% in dividend yield. And that's not really going to cut it for most people. Now, of course, SHD is more of a defensive ETF, paying you reliable dividends, but a lot of people have been transitioning to ULTY, and for good reason. You're going to get that weekly income versus SHD, which is going to be quarterly, and it's going to be about an 86% distribution rate based off of its last distribution of 10 cents. Now let's go over our return and investment into ULTY. If we head over to Robinhood, we can see I have a little bit over $7,500 into ULTY, which is going to be approximately 1,250 shares. Now, this portfolio in Robinhood account is purely focused on income generating assets, and ULTY is going to make up a pretty good portion of this portfolio, about 15-16%, and is one of the highest yielding ETFs in this portfolio. But we can see we do have an average cost basis of $6.15, and I've bought this ETF over the past few months, accumulating over 1,000 shares now. And we can see in a prior video where I had only 3,000 invested, we can easily see that we've more than doubled our portfolio size, just because ULTY has been very good lately. Let's get into all of these statistics. So we do have an average cost basis of $6.15. The share price is $6.07. So we are down about 1% or $94, but that's really pretty much nothing. And what really counts is if we scroll down to the history and go into the dividends. So if we see our history, we have been constantly buying more and more shares of ULTY as the months have been going. And I have been doing limit buy orders versus manually dripping, reinvesting, mainly because I would like to buy shares on the X dividend date where you're going to get shares of this ETF a little bit cheaper. And that has been my strategy, and it's been working out pretty favorably so far. So if we sort our history by dividends, we can see we've been getting paid week over week. Our last week, August 8th, we received a massive $120 from ULTY. And we can see the dividends have been growing week over week, mainly because we have been buying more and more shares using the dividends from this ETF as well as some other funds. And we have been doing this since May 30th, so about 3 months now. And we can see we started out with an initial 300 shares. We got paid 9 cents. 9.5 cents May 30th, and it's been growing week over week and has been doing exceptionally well, and we have been continuously adding more and more shares every single month. We can see it's been increasing to 33 cents per week. This week we got 35, then it increased to 46, 48 in July with 500 shares. And in July, at the end of July, we did end up buying some more shares up to 800. And starting in August, we did achieve our 1,200 share goal, which is going to give us over $100 every single week, which is absolutely sweet. And if we plug it all into a spreadsheet to kind of see the numbers and add them all up, we've received $600 and about $20 from distributions since May 30th. And if we take into account the share price depreciation of $94, we have easily made over $500 $500. If we do 620 minus $94, that is going to be a positive total return of $526. Now, a lot of people are not taking into account the total return of this ETF, which is the main thing. And people are going to look at this year to date down negative 33%. And that is why a lot of people are staying away from this ETF. They're looking at the share price alone, seeing that it's down quite a bit, about a third since January. But if you do take into those total returns, especially with the dividends reinvested, you can actually see it's up 15% year to date, which is actually beating the S&P 500 as well as the NASDAQ 100 index by a considerable amount. If we take this total return of $526 and divide it by 7,500, which is our investment in ULTY, we can see it's about a 7% return, total return in just 3 months. Absolutely amazing. And considering that most of the buying of ULTY has occurred last month, we can expect this total return percentage to increase even further, mainly because a lot of those shares that I've bought have not seen distributions yet. And that's only going to add to the higher weekly payouts, which is why a lot of people are investing in ULTY. Now, of course, there are risks with ULTY. It has been pretty consistent lately, as we can see. The past 4 weeks have been 10-cent distributions, which is absolutely amazing. And that's giving investors in ULTY an over 80% distribution rate forward facing. But we can see the distributions ever since it went weekly in March 13th have been between 8 and 10, actually 11 cents per share. So it's very consistent, it's been very reliable, and most of these distributions have been return of capital, so it's actually quite tax efficient. And if you're not familiar with return of capital, it's basically going to reduce your cost basis until it hits $0. And you're not going to really see this on most brokerages. It's just going to show what you bought it for. But basically, return of capital is going to lower your cost basis by the distribution amount until it hits $0. And in that case, it's either going to be taxing your distributions as short-term or long-term capital gains, depending on how long you hold ULTY for. So if you hold ULTY for under a year, you're going to be taxed on those distributions as short-term capital gains. And if you hold it longer than a year, those distributions are going to be taxed as long-term capital gains, which is going to be very favorable for tax treatment. And if I did get anything of that wrong, please let me know in the comments. I don't want to give any misinformation to you guys. But we did mention that there are some risks with ULTY, and that is going to be their underlying holdings. Now, of course, this ETF does have its risks. It's not going to stay around $6 forever, but we can take a look at their holdings. And if any of their holdings does poorly, then ULTY, of course, will do poorly as well. And we can see ULTY drop with the overall market just because it does hold underlying shares of these stocks. And we do hold very volatile stocks such as Coinbase, AppLovin, we have Robinhood Markets, and Palantir, Reddit stock as well. So these stocks in this ETF can very well drop pretty hard because this ETF is choosing the most volatile stocks as its underlyings, because it's going to give you the most option premiums and distribute that as distributions to investors. But because these are very volatile stocks, we do need some downside protection. And with the new strategy change, they're actually buying protective puts. So if, say, Coinbase goes to $0, which is highly unlikely, you're not going to lose much in value if it's holding a protective put against Coinbase. And because they're buying protective puts, we're not actually seeing a 120% distribution rate as it was prior to the strategy change. It's going to be closer to an 80% distribution rate because it does have to use some of those option premiums to buy puts, which is a very good trade-off in my opinion, because we want something that's a little bit stable and we don't want to have too much risk with this ETF. Now, the pros and cons with ULTY I've seen, it's going to give you big frequent payouts, and it's going to give you predictable weekly cash flow, and it's great for income reinvestment. Now, the cons are you're going to have capped upside due to covered calls. So if, for example, Coinbase stock, which is the number one holding in ULTY, goes to $1 million per share in just a week, you're not really going to see that gain in ULTY because your upside is capped by selling a covered call. And another con is going to be taxes are very complicated with ULTY. Now, it may be tax efficient, but it is pretty complicated, and it's something that's very hard to track unless you're tracking every single weekly distribution. And the last con is the share price can slowly drift lower over time, especially if nothing is really moving in the market. Now, currently I have 1,250 shares, making up roughly 15% of the total portfolio. And I think that's a pretty healthy number, especially since this is just one portfolio of many that I hold. And I do want to mention this is in a taxable brokerage account because I do plan to use some of the funds from this ETF for personal expenses. But so far, my $7,500 experiment has so far proven that when used correctly, these can be powerful income tools, but they're not for everyone. And if you want big share price growth, this is not it. If you want cash flow now, ULTY definitely delivers.